everyone. I'm Kate Hogarth and I'm a lecturer in the School of Accounting at QUT. I'm also a chartered accountant, so I've gotten all the questions that you gave Philippa, so I'm just going to go through the answers to these. So first question then, in the My Reports I found concession sales. Google this term, it refers to the shop within a shop, the top label set up. Any further insights here? Yes, so concession sales refers to brands that essentially rent out space within a department store to sell their brands. The department stores then will receive some sort of predetermined percentage of total sales value, and the arrangement generally includes advertising and other benefits from the brands to the actual shop. Impairment cost is another term that I came across. How does this differ from depreciation? Well, as you know, depreciation is essentially the allocation of the cost of an asset over its useful life, the accounting period it will be used for, rather than expensing the whole amount for the year of the purchase. Whereas impairment occurs when the carrying amount of the asset is greater than the recoverable amount, or in other words, higher than the fair value. We usually see impairment when there's a reason that the asset has changed. For an example, an unusual or drastic drop in the fair value of the asset. Could also be if it's getting ready for sale. They might have changed the way they classified the value of the asset, or they may merge some of the asset types. That's when we tend to see impairment. So it tends to be more of a one-off drastic decrease in the value, whereas depreciation is that set distribution of a reduction of the asset's value over its useful life. This one was in relation to bargain purchase in the expenses section. Where we see bargain purchase is in a business combination. So the bargain purchase occurs when the fair value of the net assets of the acquiree exceeds the purchase consideration paid by the acquirer plus the fair value of any non-controlling interest. The difference between the two is recognized as a gain by the acquirer because they've gained more than the value that they've paid for it. It's also sometimes referred to as negative goodwill because it's opposite in nature of goodwill, but so being a premium for a business acquisition. As to why it would have been in the expense section, the only thing I could think of was that there may have been an impairment on the gain on bargain purchase, and that's why it was in expense section. I'm not 100% sure though. I'd have to actually see the report, see the statement of profit or loss. Discontinued operations. So I guess in terms of how should you consider it, I guess I'd recommend just to note that these will not be continuing revenue streams, so they're not important for future period. We find that the discontinued operations are important for forecasting purposes too when analysts are making future projections. So that is, these operation and business activities are taken out of future revenue streams because they've been sold to another entity. Why do we use NPAT and return on equity versus NP before tax for return on total assets? The reason we use net profit after tax is usually used with ratios linked to equity because this is part of that whole picture, whereas return on assets is often aligned to net profit before tax, as tax can sometimes distort from year to year depending on the tax payable position. Why do we use net profit after tax for earnings per share? When a company is owned by a parent and a partner, the applicable matrix is the net income attributable to the shareholders. So this subtracts out any earnings on which the other party has a claim to. Earnings per share and diluted earnings per share are obviously profitability measures that we use in the fundamental analysis of companies. So earnings per share only takes into account a company's common shares, whereas diluted earnings per share really takes into account all convertible securities such as convertible bonds, convertible preferred stock, which are changed in the equity and common stock as well. What does it mean by equity holders of the parent entity, and are these different to shareholders? Well, if an entity has a parent, then we need to separate out the equity holders of the parent equity entity, otherwise, in other words, the shareholders of the parent. Then you might also have the shareholders of the subsidiary entity, of which the parent is one of them. Non-controlling interest, you might also see these referred to as minority interest. It's an ownership position where the shareholder owns less than 50% of outstanding shares and they have no control over decisions. They're measured in net asset value of the entity and they don't hold any voting right. So that's why they're referred to as non-controlling interests. Equity instrument reserve. An equity instrument obviously refers to a document which serves as a legally applicable evidence of ownership right in a firm. It's like a share certificate. They're generally issued in company shareholders and are used to fund the business. The reserve account is a capital reserve or equity reserve. Contributed equity, is this the same as shareholders' equity? No, it's not. Contributed equity, you might also see that called paid up capital or paid in capital, is the total value of the amount that the shareholders have actually paid to the company, because it's not always the same as the total value of shareholders' equity, as the shareholders may have an unpaid portion of the equity. So the company may have only asked for them to pay, you know, say out of a $2 share, they might only have to have contributed capital of $1 share. Then they might keep that other dollar in reserve for if they need to generate some cash flow quickly. They might then call on their shareholders to pay up more of their capital. The next questions relate to the ratios. So this one is earnings before interest, tax, depreciation, and amortization. So it's what we call a baseline measure. So it's how well the organization does in its core business. And so what it does is really gives insight into profitability by stripping away, you know, the interest, the tax, the depreciation, and amortization to concentrate on the main business operations. It is similar to the net profit ratio as well. The debt to equity ratio, now it measures the extent to which a company is using its debt financing capacity. So it measures the ratio between the company's borrowings from a bank and others compared to shareholders or owners' equity. The gearing ratio, now we use this as a measure of financial leverage. So it demonstrates the degree to which a firm's operations are funded by equity capital versus debt financing. This one, so the accounts payable turnover ratio refers to how many times the firm is paying their accounts payable in a year. So this we use as an indication of how much cash flow the firm might have to be able to make payments to suppliers. 3 cash ratios. So the operating cash flow, it's a measure of cash profitability. So what percentage of cash from operating activities compared to sales. This compares operating activities to total cash activities, so operating, investing, and financing. And the long-term debt coverage, it provides a measure of the ability of a business to actually generate net cash inflows from its operating activities relevant to all its obligations. We do ignore dividends in that one though. So some formula questions. Net profit is incorrect, as these days it's operating profit. You will find though that some companies will still use the term net operating profit, so it depends on the actual annual reports that you actually see. So there were quite a few questions on the difference between owner's equity and shareholders' equity. In the case of a public company, it should really be shareholders' equity. We tend to see owners' equity for smaller businesses, not publicly listed companies. So they actually have an owner rather than shareholders. So I do agree with you in that statement. We do, though, sometimes say that you'll find some companies classify shareholders' equity as just ordinary shares held by shareholders. So if they have other classification of shares, they might not actually include that in shareholders' equity, and they might then have an owner's equity. So it really does depend on the actual company itself. Is total revenue just revenue, or is it income or total sales? It's not necessarily total sales, because they may have other source of operating income. Total revenue or total operating income does not always include items that are not usual, so revenue from discontinued lines or operation, but it would include total sales revenue. So again, it depends on the actual annual report you read. Should have quick ratio as the name. Yes, I 100% agree with it. The correct name for the ratio is actually the quick ratio. So it's an indicator of the company's short-term liquidity position, and it measures a company's ability to meet its short-term obligations with its most liquid asset. So it is also referred to as the asset test, but it's the reason we call it a quick ratio is it's a quick test designed to produce instant results, hence the name. What's the difference between total liabilities and total debt? It can be the same, but it might not always be the same. So often businesses, if they haven't interchanged the names, total liability are all obligations that the company faces in the next 12 months and beyond that. So that includes their tax debt, all their debts, all employee obligations like accrued wages, leave, etc. Whereas they might then refer to debt as just money that is borrowed that needs to be paid back at some future date. So some organizations will use liabilities as a broader term constituting all of them, and then they might have debt as part of that. Other organizations will refer to them as the same thing. I tend to see most of them separate them out though. The difference between short-term and long-term is generally the operating period of 12 months. So short-term relates to the next 12-month period, the financial period, whereas long-term obligations are longer than that next 12 months. Overdrafts can be both long and short-term obligations, but are a cash equivalent, so they're similar to a loan. Equity investment in the gearing ratio, what does this mean? It essentially means total equity. So gearing is a measurement of the entity's financial leverage. So it demonstrates the degree to which a firm's activities are funded by shareholders' funds, equity, versus creditors' funds, liabilities. How are supplier purchases worked out? We simply calculate them generally as total purchases made by the entity for that period. The dividend yield ratio is essentially the annual dividend per share presented as a percentage of the sales price, while the price to earnings ratio is the ratio of valuing a company that measures its current share price relative to its per share earnings or earnings per share. Sometimes you will see the price to earnings ratio as the price multiply or earnings multiply. Share price is commonly used term on the stock exchange, so that's what we tend to see more of. You might sometimes see market value per share, as that's something we tend to see in foreign financial statements or ones that have parents who are foreign entities. But share price is what's more commonly used for the Australian stock exchange. Operating cash flow ratio is a measure of the number of times a company can pay off its current debts with cash generated within the same period. So a high number greater than 1 indicates a company has generated more cash in a period than what is needed to pay off its current liabilities. This is opposed to the other cash flow related activities of investing and financing. So that's why there's separate ratios. The operating cash flow is usually a note in the statements of cash and cash equivalent that links back to both the balance sheet and the cash flow statement. Then we had some naming differences. So net profit and operating profit, as I mentioned before, are equivalent terms. Owner's equity, total equity, and equity investment are all equivalent terms. Total liabilities and total debt, as I said before, they can be equivalent, but sometimes they are separated out where total liabilities are all obligations, whereas debt refers to financial obligations. So short and long-term debt. Non-current liabilities, long-term obligations, and long-term debt. All non-current and long-term are over that operating financial period of 12 months. Again, it depends how they're classified. So liabilities might be all obligations, which is generally going to be the same as long-term obligations, but debt may just be the financial obligations. Short-term and current liabilities are equivalent terms, so that's the short 12-month operating cycle. Market value per share versus share price, yep. These are both the same thing. So, but share price tends to be what the ASX uses. Net sales versus revenue, assuming that it's sales revenue, generally all meaning the same thing. Sales, and if revenue's just from sales, then yes. If revenue includes income from other things rather than just sales, it might not be exactly the same. However, net sales tend to be sales less sales returns, so it might be a slightly different value than total sales. There seems to be a few different values for profit. Profit would normally indicate the net profit after tax from continuing operations, yes. So just not including discontinued operations. For prepayments, I would assume 0, but you could have the students look to see if there's a related note in the financial statements, and if they're not, then you just assume there's 0. Similar with this one, assume it's 0, but you could also have a look at a related note for cash or cash equivalent to see if there's actually an overdraft. For this one, I would recommend using companies where revenue and cost of goods sold are actually supplied, as it can be quite challenging to calculate it if it isn't supplied. I would imagine that they wouldn't actually have to calculate those at this level, as we don't require our first years to calculate it either. With total supplier purchases, it's actually not mandatory to present this level of detail in publicly listed statement. So actually calculating the cost of sales, if it's not supplied, that it's actually going to be quite challenging for the students. In terms of if freight is listed, it's If it's identified as an expense in cost of sales, then it's a freight inwards cost. Freight outwards is typically a revenue, so postage and handling on sales, and would actually be offset through the cost of sales. Typically, dividends paid in the cash flow statement align to 2 dividends declared, but there may be timing issues. So dividend per share is the total dividends declared in a year divided by the number of outstanding ordinary shares that have actually been issued. Yes, and it can be found on the ASX website. Oh, and that's it. Thank you very much for listening.